Chuck Carnevale, I'm the Chuck in the Markets Up Chuck. As I'm doing this recording, I'm looking at the stock value of both IBM and Google, which I'll be talking about as I did briefly in the blog today. And IBM with a 12% earnings increase is seeing their stock price up about 3% today, and Google with a 19% increase is seeing their stock down about almost an equal amount. So I thought it would be useful and important, because these are obviously headline companies, to take a look at what these companies really look like, and what their earnings reports actually mean and what the long-term prospects for their businesses, based on current forecasts look like. So first, let's look at IBM. If you look at it over the last 15 years, you'll see that IBM has grown earnings, rather consistently, especially for a company this big in the technology sector, which is known to be somewhat cyclical, at around a 14.4% compounded return. You can see stock price followed that. When the stock price got overvalued, as it always does, it comes back into value. And then when it got very undervalued towards the end of 2008, we've had this strong recovery. And, the 14% number equates pretty nicely with the 12% earnings report that they just announced. On a track record basis, shareholders over the last 15 years would have turned 100,000 into 600,000. That's a 13% rate of return. That's significantly better than putting the same amount of money in the stock market. So Big Blue, as it's known, has done very, very well. On a forecasting basis, the forecast is for 10% growth. They did 12. But here's a point I want to make. The company is trading at a very low price earnings ratio of 12, but assuming that they grow at 10 or 12%, and even if they trade at, let's say, a more attractive 15 times earnings, you're going to have a 8, 9, 10, 11% long-term rate of return, not counting dividends, buying IBM today. If you contrast that with Google, whose stock is down today as a short-term reaction, the numbers are totally different. When you look at Google, a very strong company with no debt on its balance sheet, you can see it's obviously a young company. It didn't even exist, 15 years ago as IBM did. But for the last, 6 years, or at least since late 2004, Google has grown earnings at a compounded rate of over 84% a year. They announced a 20% or 19% growth rate for this quarter. That is 2 percentage points better than the consensus long-term estimate. The stock is trading at a 24 multiple. However, I do want you to notice that if it grows at 17% a year, then even if the price-earnings ratio shrinks down to 17 from its current 24. So, in the case of IBM, I talked about the price-earnings ratio increasing, by quite a bit. If if the price-earnings ratio shrinks with Google, you still would end up with a double-digit rate of return here. So the point is, in the long run, it's the earnings that determine market price. Google, in its 6 years, has obviously a stellar track record, over 35% compounded versus an S&P 500 that lost 3%. So, the point of today's post is not to predict whether each of these companies are good investments from here or not. I think they're both good companies. I think they're both excellent. But just to put the perspective and to take the headlines that you hear and read and to put them into perspective from a standpoint of what the actual numbers mean. And that's all I'm really trying to accomplish in today's blog. It's been Chuck Carnevale. I hope you found this somewhat enlightening. I look forward to talking to you again on Monday. As usual, we'll be taking the weekend off. You have a great weekend, and we'll talk to you again on Monday. Thanks for listening.